2024 is slowly coming to an end, and it's this time of the year where we start wondering what is the real estate market going to be here in Milwaukee in spring of 2025. Maybe you are contemplating some moving plans and scratching your head on the best timing for that, then you came to the right place. Of course, it is the future. Nobody knows it. A lot can happen between now and then. But real estate is relatively predictable. It moves kind of slow. And I've been doing this for over a decade here in Milwaukee. I'm a data guy, and there is a lot that the data in the fall market can already tell us what is likely going to happen in spring. Fair warning, this is not going to be a clear answer. The picture that we're getting is somewhat murky because you have conflicting forces that are pulling the market in one direction or another. And then it really depends which one of those effects tends to be stronger than the other one. So we'll take a look into this. This is a complex topic, so I decided to make this a two-part video. In part one, we're going to take a look at some macroeconomics, at consumer confidence, and some other statistics that really drive the real estate market. And in part number two, we're going to take a look at supply and demand, specifically for Milwaukee, how demographic trends here in our metro area are impacting our real estate market, and what we can learn from that will help us understand better what's ahead of us in 2025. And along the way, I have some interesting statistics for you. For example, you may have read that the net worth of a homeowner is many times higher than the net worth of a renter. And if you would take a really high guess, I promise you, you would still be low. So real estate really plays a strategic financial role in your life. And we'll get to that a little bit later in this video. Let's get started by defining the question a little bit better, because depending if you're a buyer or seller or both, it may look quite a bit different. So the first question that we always have is about inventory. If you're a buyer, of course, more inventory is better for you. If you're a seller, that's not necessarily helping, because that also means more competition. And that will tell you how competitive the market is going to be, what you can expect at certain periods in the market. What direction are we going to see with real estate prices? Of course, we can't tell what appreciation is going to be exactly next year, but we can get some good idea from previous trends. And then strategically, what is the best time to buy and or sell, depending if you're doing one or the other or both. You may have a very, very different scenario. On that note, it also depends a lot in which part of the Milwaukee metro area you are. The markets behave differently. Brookfield different to the Third Ward and different to Cedarburg or Mequon. And then, of course, you have your personal situation. There is a lot to consider. If you want me to help you a little bit with laying out a strategy for you personally, don't hesitate to reach out to me. The easiest way is always to send me an email at m.auerbach@kw.com. And you can find all my contact details in the description below this video. Let's get started with some data from the conference board. They are measuring a consumer confidence index. And I'd like you to focus on the black line here first, because that is how consumers perceive the current situation. And that is driven a lot by the economy. It's driven by inflation and by interest rates. And those are the things that we're going to be examining in just a little bit. No big surprise here. After the 2008 recession, consumer confidence came up here quite a bit. And of course, COVID happened. And in the wake of COVID, we were dealing with a lot of inflation and we're dealing with high interest rates. So that really kept consumer confidence quite a bit lower than it was before. But also, we have to say, in historic context, it's not the worst. But we can notice very clearly here, consumer confidence took a turn for the worse in September. To me, that is relatively easy to explain with the upcoming election, because the country is split down in the middle and each side believes that if the other side's going to win, the country is going to go down the drain. So, of course, that's not good for consumer confidence, but I think that will clear up as soon as we have election results here. And we get more visibility and predictability to what's going to happen there. We know from historic research on election results that it usually doesn't impact the housing market very much if we have a Democratic or a Republican president. But of course, policies can have an impact. But I do not expect policies to be in place early enough to really impact the 2025 spring market. The blue line that you have here is the expectation index. So that is how people are seeing the future. And based on inflation, based on shrinking purchasing power that consumers have, the outlook for the future is somewhat pessimistic. But it's important to notice that consumers tend to look at everything in the rearview mirror. So you have a recency bias. You're looking at what happened in the last 2 or 3 years, and that is kind of shaping your outlook for the next few years. So let's take a look at inflation first to understand the dynamic that's happening here. So just a quick refresher, of course, COVID happened, then the Fed decided to print a lot of money to keep the economy from completely drowning. Unemployment rate, of course, spiked. So about 30% of the US dollars that we have in circulation today were printed in the last 5 years as a result of that quantitative easing, trying to keep the economy alive. And that worked, but we did pay a price, and that came in form of inflation. So that spiked here in 2022 at over 9%, and it's coming down nicely. We have seen the latest reading here at 2.4%. That's the lowest since February 2021. So the Fed is trying to cool down the economy to the point where they're willing to drive unemployment rate up a little bit. Just the economy has to cool down in order to get inflation under control. And if you look at where we are at 2.4%, you can see that's kind of somewhere in line with where we have been for the last 40, 50 years here. We're going to have another reading here later this week. The expectation is 2.3%, and a lot will hinge on what the next reading is coming out to. But it doesn't really change the big picture. So here's something that I want you to understand about inflation. Inflation is really the gradual decline of the value of the currency, in our case of US dollar. So here you have inflation since 1984 in the form of an index. And that means when we're starting with the value of $100 in 1984, then the same goods and services would cost $200 in 2006, and then we're at $300 here in 2023. Currently almost getting up to 320. So what can you read from this? The value of the currency is going down over time. This is a relatively linear effect, so it's on average about 2.6%. This is where the Fed is kind of aiming for the 2% range. And you can read from this that it takes about roughly 25 years for the value of the US dollar to be cut in half. Maybe you remember that if you're around in the 80s, what ice cream or popsicle would cost, or what a beer would cost back then, and how much it costs now. The same is also true for real estate. So if you would have bought a house for $100,000 here, and then it's worth $200,000 here, the house hasn't really gone up in value. It's still worth the same measured in the cost of labor, cost of materials, how much you're making. It hasn't really gone up in value. It's just the US dollar has been cut in half. So that means you need to bring twice as many dollars to buy the same house as you would in 1984. So I think that is a principle that you need to keep in mind if you're trying to understand some of the other statistics I'm going to show to you. The value of the currency compared to hard assets like real estate, for example, but also precious metal, is going down over time. Warren Buffett famously said his operating assumption is that the value of the currency is going to zero at some point in the future. That's how he's looking at this. All right. But there is something that is very important when you talk about inflation, and that is how much wages are growing compared to inflation. And something very interesting happened in the last 5 years. So we have here two lines here. The blue line here is wage growth, and the red line here is inflation. So for the longest time, wages have been growing faster every year in percent than inflation. And then 2021 happened, and these curves flipped around. So all of a sudden, inflation was going faster than wages, even though we had an employment shortage, and you remember there were for hire signs everywhere, and wages started going up. It wasn't fast enough. And so in this red area, people have lost a lot of purchase power because the rate of how prices were going up was going faster than how wages are going up. Fortunately, this has changed about in 2023. So we are back to wages growing significantly faster than the rate of inflation, but this will take time. This doesn't fix the issue. Consumers have lost a lot of purchase power. This is why the consumer confidence is so low right now. It will take time, a few years, before this will actually materialize in people's bank accounts. When you make a little bit more money every year and inflation is not so high, you're regaining some of that purchase power. But it's that recency bias. Consumers are looking back in the rearview mirror. So, if you were here, for example, and you look back, all you see is red. And we're slowly getting into that phase where we're starting being a little bit optimistic, maybe when we're seeing more and more of the positive trend. But it's probably still too early for that to really show an effect right now. But it is possible that we're seeing this a little bit differently in 2025 when we're looking back and we're seeing better wages. Now, let's take a look at unemployment rate, because unemployment is also very important for how consumers are behaving when it comes to real estate. If there is job uncertainty, if people are feeling they cannot get as many overtime hours as they would want to, maybe when they're feeling uncertainty, then usually what they do is they just freeze. They're not buying or selling real estate. They just try to wait it out until the job market gives them a feeling of more opportunity. And that's currently not happening. So we have an unemployment rate of 4.1% in the US. That's the red line. It has gone up a little bit. And that is on purpose, because the Fed was trying to cool the economy to get inflation under control. And the price you're paying for that is a higher unemployment rate. So you're trying to manage that. And then they cut the rates one time by 0.5%. And what happened? The unemployment rate responded right away and improved, went down to 4.1. That's the reason why the Fed is holding off with further rate cuts at the moment. One thing I always like to mention here, Wisconsin unemployment rate is quite a bit lower than the national, only 2.9. So we have a fantastic labor market here in Wisconsin. Really proud of our state here. And that is, of course, impacting the real estate market. At the moment, it seems like a lot of employers, a lot of companies are cutting back on overtime, but they don't want to let people go because they have a fear, they're traumatized, that it's so hard to recruit people, to get people on board. So they're kind of keeping everybody on board, but also employees are not quitting because they're kind of worried with that uncertainty if they can get another job anywhere. So it's kind of a mutual hold right now, and nobody wants to leave their job and change jobs. So that's kind of the situation that we have at the moment. Another headline that you may have heard recently was that credit card debt reached over $1 trillion. Of course, that is a great headline for the news because it's such a, $1 trillion, such a flashy number. But when you look at this, keep in mind what I told you about inflation before. This is also partially because the value of the dollar is going down. So, of course, with that, the number keeps going up. What is a better measure is how is that actually impacting consumers. And so here I have a chart that gives you household debt in percent of their income. And, yes, that has significantly increased here in the last years. We had all that PPP money going out, all that COVID stimulus money, that really a lot of people used that money to pay down their credit cards, for example, or pay off car loans. And that effect is gone. And so from that point of view, yes, debt load on households has gone up quite a bit in the last years. But when you look at this in historic context, we're still sitting actually relatively good, definitely a lot better than we were here before the mortgage crisis in 2008. So I'm not too worried about that on a big picture. There's no red flags here for next year's real estate market. We can break this down a little bit more and go into the different categories of debt. The blue line here is real estate. So that really came down nicely after we cleaned out the real estate market after that mortgage crisis here. So we are low and stable here. Also commercial and business loans and other loans, car loans are in here, not worrisome. What is a little bit concerning is that credit card delinquencies are going up quite a bit. When you look back here, historically speaking, we are still relatively good. but nonetheless, the trend here is not favorable. And when people are feeling the weight of credit card debt, especially first-time homebuyers, that doesn't make them very likely to be able to qualify, have the down payment, and have the necessary debt-to-income ratio to really start and get their first property under contract. So they are basically stuck with renting, and there is a rent-to-income ratio. You've probably heard this many times, that you should be making 3 times the money that your rent is going to cost. That's that rent-to-income ratio. There's a 30% threshold there. And the US as a nation has become rent burdened over the last years. We talk about rent burdened when the country is on average over that 30%. So we're significantly rent burdened here. And there are markets in the country, especially on the East Coast and on the West Coast, where this ratio looks way worse, where people are spending upwards of 50% of their income on rent. And oftentimes then 2 families or a bunch of friends basically renting 1 unit together and are sharing it because none of them could afford rent on their own. In Wisconsin, we're doing still pretty good, even though this ratio has increased slightly in recent years because rents have also gone up in Wisconsin. We're still doing better than we were here in 2010. But overall, Wisconsin rents are more on the affordable side than we have seen in other parts of the country. Let's explore it a little bit more and take a look at the correlation of home price appreciation versus rent increases. So this chart is giving you the percentage increase every year. Let's take a look at home prices first. So home prices are definitely a lot more volatile. You can see here prices were running up, and then we actually went into the negative. So homes lost value here for quite a few years before we came back into the positive. Then we had relatively stable appreciation for a number of years. Then the unicorn years happened around COVID. Home prices shot through the roof. We had some markets in the US that went up by crazy amounts, like 30 to 50% every year. They did it in a couple of years in a row. And now things have normalized, stabilized again. So this is where we are with home prices right now. We are in a more stable and normalized appreciation pattern. When you look at rents, the risk of rents going negative is a lot less. We only had a brief period here where we saw some rent decreases, but generally rents are going up relatively predictable every year. We are here just below the 5% line. And just in the last few years, we have seen really high rent increases. That has really increased the motivation for a lot of renters, that they said, no, we're getting old enough. We've been renting for way too long. We really want to buy a home now because this is getting worse and worse. And there is a real threat to that, because you eventually can come to that situation where you're so cost burdened with your rent that you cannot afford to save up a down payment, and you're stuck in that renting cycle until forever. All right, interesting statistic you might say, but what does that actually mean for an average US family? I mentioned earlier in the video that there is a staggering, shocking difference between the net worth of renters and homeowners. And if you are taking a guess and you guess high, I promise you're probably still low. So let's take a look at the numbers. Here is data from the Fed. An average US renter has a net worth of $10,400 compared to a homeowner with almost $400,000. So that is a huge difference. And you might say now, well, those are the people that live in the suburbs, etc. That's not true for all the income brackets. Let's break it down and let's take a look by household income. And you can see here the green part is real estate equity, and even households under 30,000 here in the middle, we got 50 to 90, the $150 to $250,000 household income. Real estate, the green part here, is an important part, the big part of people's net worth. Of course, if you go into the higher income brackets, they tend to have more in retirement savings, 401ks, in stocks and mutual funds, so that becomes a bigger portion of it. And this proportionally, you can say in smaller incomes, real estate represents actually the largest chunk of their net worth. And this has huge implications for a family, for sending kids to college, for retirement savings, for all sorts of things, for generational wealth, even what you're able to leave behind for your kids. So real estate has really a big part of your strategic financial planning. And the concern for many people is that they got stuck in renting for too long. A lot of millennials find themselves in the situation. Rent in Milwaukee 10 years ago used to be on average about $14,200 a year. And that has increased now to $19,200. So if you do the math over 10 years, many of them have spent anywhere between $150,000 to $200,000 in rent, and they have nothing to show for. So of course they're realizing this, and that is creating a lot of motivation in younger people, in millennials, but also in even younger generations. They want to buy their first home. They want to get out of that ever increasing rent race. And that's it for part number one. Part number two, we're taking a closer look specifically at the Milwaukee situation. Where is supply and demand coming from? What can we expect for mortgage rates next year? The latest outlook on that and how that is impacting our local real estate market. And then also at demographic breakdowns of buyers and sellers and how the different demographic groups are going to impact the real estate market next year. If you have any questions, my contact information is in the description of this video. Send me an email, m.auerbach@kw.com. Looking forward to hearing from you, and I'll see you at part two.